Most people who are getting into buying a business ask the same question pretty early on. What's the multiple in this industry? And honestly, it sounds like a smart question. It feels like the right place to start. But here's what I'm finding after closing over 600 transactions. That question, asked in isolation, is quietly causing buyers to either overpay for businesses or walk away from deals that actually made sense. And most of the time, they never even realize it happened. Today, I want to walk you through what multiples actually mean, where most people get the math wrong, and a simple 2-word framework I use to filter almost every deal I see. I'm Trent Lee. I'm the #1 business broker in the country, and I've closed over 600 transactions across a wide range of industries. I make these videos because I see the same mistakes happening over and over. Mistakes that cost people real money, real stress, and sometimes things they really can't afford to lose. I'm not here to tell you there's one right way to do this. What I am going to share is what I'm actually seeing in the market right now and what I've found works when you're trying to figure out whether a deal actually makes sense for you. By the end of this video, you're going to understand why 2 deals can both be described as 3 times earnings and be completely different investments. You're going to know how to look at any business and quickly ask the right questions about risk and how long it takes you to get your money back. And you're going to have a filter that could genuinely save you 6 figures on your next deal. So here's how most buyers think about multiples, and I get it because I've seen it hundreds of times. Someone says, this industry sells for 3 times earnings. So you take the earnings number, multiply it by 3, and suddenly you feel like you know what the business is worth. It's clean, it's simple, it feels professional. The problem is, what earnings? Because net income, EBITDA, SDE, and revenue are not the same number. Not even close. And when you multiply the wrong one, you can be off by hundreds of thousands of dollars on the valuation. For most small business acquisitions, the number that matters most is SDE, seller's discretionary earnings. That's the owner's salary plus the business profit combined into one figure, because the assumption is that you, as the new owner, are going to step into that role. So if someone shows you an SDE of $150,000 and tells you the business is trading at 2 times SDE, that's a $300,000 purchase price. On the surface, that looks like a 2-year payback. You make $150,000 a year, you paid $300,000, you're back to even in 2 years? Sounds great, right? But here's where most people stop doing the math, and it's the part that really matters. Out of that $150,000 SDE, you are working full time in that business. So you have to ask yourself, what would it cost to hire someone to do what you're doing? If the fair market wage to run that operation is $80,000 a year, then the true profit above your labor isn't $150,000. It's $70,000. Now look at the deal again. You paid $300,000. Your true annual return above paying yourself fairly is $70,000. That's not a 2 times deal anymore. That's over 4 times true earnings. And now your payback period isn't 2 years. It's more than 4 years just to break even after compensating yourself at market rate. This is where the math starts to tell a very different story than the headline multiple suggested. And here's what that actually means in practice. If you're paying 4 times true profit, you are quietly betting that this business will stay stable and perform consistently for at least 4 years just to recoup your investment. You might not be saying that out loud, but that's exactly what the math is asking you to accept. So what's the framework I use to make sense of all this? I call it risk and recoup. 2 words, that's it. Every multiple is really just a reflection of 2 questions. How risky is this cash flow? And how long will it take me to get my money back? Those 2 questions cut through a lot of the noise, because when you start asking them specifically, you stop thinking about the industry average multiple and start thinking about this particular business, this particular cash flow, and what has to be true for this deal to make sense for you. Here's a real example of what I mean. I worked on a deal where the business looked solid on paper. The SDE multiple was reasonable, the revenue was consistent. But when we dug into the customer base, 60% of the revenue was coming from 4 customers. 4. That's not a risk you can ignore when you're running your recoup math. If one of those customers decides to go a different direction, the entire financial picture of that deal changes overnight. That's not me being dramatic. That's just cause and effect. And the multiple never told you that. You had to ask the right questions to find it. Now, here's the part of this conversation that I think gets skipped too often, and I want to be straightforward with you about it. If you're using an SBA loan to buy a business, which most first-time buyers do, you're signing a personal guarantee. That means your home, your credit, your financial security, and honestly, your family's comfort level are all tied to that risk and recoup period. If cash flow drops in year 1, the bank isn't going to tell you, well, the industry multiple said this was a reasonable deal. You're on the hook regardless. So the real question I encourage every buyer I work with to sit with is this. If revenue drops 20% in year 1, can this business still cover its debt, pay you fairly, and stay stable? If the answer is no, then you either need a lower price or better deal terms. A seller note, an earnout tied to performance, some kind of offset connected to customer retention, and structure can cushion risk in a way that a negotiated multiple can't. There are absolutely deals where higher multiples make sense. If the business has diversified customers, strong systems, real management already in place, and low capital reinvestment needs, the risk profile is genuinely lower. Lower risk can justify a longer recoup period, but you have to be honest about what you're actually buying and whether the structure of the deal matches the reality of what you're stepping into. So here's what I want you to walk away with today. Multiples are tools, not answers. The real work is understanding what's underneath the number, what the cash flow actually is, what it costs you to run the business, and how long you're betting on stability to get your money back. Risk and recoup. Keep those 2 words with you every time you look at a deal. Here's your challenge for the next 24 to 48 hours. Find a business listing. It doesn't even have to be one you're serious about. Just find one. Look at the asking price and the stated earnings and run the actual recoup math after accounting for what it would cost to fairly compensate yourself to run it. Then ask, if revenue dropped 20% in year 1, does this deal still work? Just that question alone will change how you look at every deal going forward. Drop your number in the comments. I read them, and I want to see what you're finding out there. If this kind of logic first breakdown is helpful to you, I have a free school community where we go a lot deeper into all of this. Over 30 hours of step-by-step education on how to find, analyze, and buy a small business. It's completely free, and the link is in the description below. And if you haven't subscribed yet and you want more of this kind of content, go ahead and hit that button. We cover deals, frameworks, and real-world case studies from what I'm actually seeing in the market. I'm Trent Lee. Remember, the best deals don't just have good numbers, they have good math and measured moves.